How you doing, everybody? This is Kurt Henry at the Mortgage Center with my dad Randy, and this is a review on the mortgage market in 2012, along with a little bit of a prediction going into 2013. Normally I do a weekly mortgage update to let you know what's going on in the mortgage market, and I normally try to keep it within about a minute to make it quick. And on this video, I'm going to reflect a little bit, so it's going to be a little bit longer, but I'm going to have some interesting stats and information if you're interested. So last year there was, or in 2012, there was a survey by TD Canada Trust that was done, and it found that 6% of first-time homebuyers did not budget for anything in terms of purchasing a house, anything other than their down payment. And 13% of first-time buyers forgot about one-time fees like land transfer tax and home inspection, stuff like that. And 60% of first-time home buyers wish that they were more thorough when they were budgeting to purchase a home. So that's basically what we do as a mortgage broker, is we take you through everything. Not only do we have all the banks compete for you to get you the best deal, and there's no cost for our service, but the other thing that we do is take you through and prepare you for when you actually want to purchase a house. So whether you're purchasing in 6 months or a year from now or a month from now, it's still a good idea to look into things even if you're 6 months to a year away. Now, having said that, in 2012 there was a lot of changes. So the first, well, not the first, but I guess the latest large changes were by CMHC. And CMHC, if you're not aware, has to insure a bank when you're getting a mortgage with less than 20% down when you're purchasing a house. So no matter what bank you go to, if you have less than 20% down, the bank has to be insured, and one of those insurers is CMHC. So when CMHC changes their rules or guidelines on underwriting, it affects a lot of home buyers because it affects mostly home buyers that have less than 20% down, which most people do when they're buying a house, especially first-time buyers. So CMHC made a lot of changes. The last ones were in July 2012, and those changes were, the major ones were on the amortization. That is now 25 years maximum. That's when you have less than 20% down payment. The other change they made was that for somebody that has a current mortgage, they cannot refinance or increase their mortgage up to any more than 80% of the value of their house. So you used to, if you had a mortgage, you could normally, before, you could increase your mortgage up to 95% of the value, and then it went up to 90%, and then it was changed to 85%, and now it's been changed to 80% maximum. That's for a current mortgage if you want to increase it. The other change that CMHC made is changes to the GDS TDS requirements, and those are just ratios on what the banks use to qualify you for a mortgage. So basically, the effect of those changes is that you can't borrow as much as you could have before. So those were changes that CMHC made. Now, more recently, and which haven't necessarily taken full effect, is the changes made by OSFI, which is the Office of the Superintendent of Financial Institutions. And OSFI is a federal regulator that regulates federally regulated banks. So it's pretty much the major banks that they regulate. Now, that's not to say that all lenders or financial institutions are affected by OSFI, such as credit unions, because they're not, but major banks are affected by OSFI. So OSFI is making changes to lines of credit, for example, where a line of credit can no longer go more than 65% of the value of a house, where it used to be able to go up to 80%. Now it's only going to be able to go up to 65% with major banks. The other thing is that major banks are not going to be allowed to use cashbacks for down payments. And the other thing is that they're making stricter guidelines on stated income programs, which is for self-employed people when they write off a lot of expenses and they show a lower net income to pay less income tax. there used to be stated income programs for those people, and a lot of major banks are not going to be able to do those programs like they used to be able to do. Now, the result of all of those changes has not been a shrinking mortgage market. And when you hear of a decline in a mortgage market or a real estate market, I would strongly suggest that you look at the difference between a decline in the market and a decline in the growth rate of the market. So if somebody says that the mortgage market has declined, it's not necessarily true, because it could be just that the growth rate has decreased. So it's still growing, it's just not growing at the same pace as it used to be. Same with the real estate market. If there's a real estate market that somebody says is declining, my first question is always, is it actually declining, or is it just that the growth rate is not growing as much as it used to? And that could be that could have a big impact on your decision whether to buy or not, because if you're waiting and the growth rate has decreased, well, it's still growing. So in a year or 3 years from now, that house is still going to be more expensive. It's just going to be more expensive than what it would have been if the growth rate had continued going as steep as it was. Now, having said that, the result of all of those changes has not been, what we have seen, has not been a decline in mortgage volume that we have been originating. In fact, the growth of our mortgage volume has still been going up. And despite all of the changes, basically what the changes have resulted in is the need for consumers and realtors to be educated on alternative ways of getting mortgage financing approved. And what I mean by that is not all banks are the same. They have never all been the same, but now it's more apparent that banks are not the same. And that is becoming more apparent to both real estate agents and consumers. And all of these changes are not resulting in a declining or a falling housing market or mortgage market. All it's doing is making it so that consumers and realtors, to this point, have had to be more educated, and they need to be able to use different channels to get mortgages. So it's not a matter of just going to the consumer's bank like it used to be. The mortgage broker channel is becoming more necessary and more valuable for consumers and for real estate agents. So I believe in 2013 that this will become more apparent still, and that people will still find the need to be more educated and more resourceful in terms of how and where to get their mortgage financing, as opposed to always just going straight to their bank. So that's my prediction for 2013, that this resourcefulness and this need for education with mortgage financing is going to become more necessary and more apparent as we go into 2013, and that is my prediction. If you have any questions or any thoughts on that, feel free to give us a call. The number at the office here is 905-436-8010. Thanks, and have a great day.